we will first complete the AS29 part which was left. So we'll start that. Now I think we have to start with contingent liabilities and contingent assets. So let us first start the discussions with respect to contingent liabilities. Now let me take back to you to yesterday's point. Now yesterday, sir, we learned provisions, correct? Now, sir, when we were doing provisions, one point is to be noted with respect to provision that, sir, all provisions are liabilities, right? So what is the logic of liability means? Sir, there is a present obligation arising out of past event, and it is probable that to settle the obligation, there will be outflow of economic benefits from the enterprise. So what word was used? It is probable that there will be an outflow of economic resources or we can say outflow of outflow of economic resources from the enterprise to settle the obligation, and even the amount can be measured. The amount required to settle the obligation can be measured reliably. This is what we learned with respect to provisions. Right? Now, with respect to contingency, I would like to change some small points. The first point with respect to provision is what? There is a present obligation arising out of past event. So I would just like to change the word present and put the word possible over there. So there is a possible obligation arising out of past event. That is one change, right? And second change, I would say that it is not probable that there will be an outflow of economic resources to settle the obligation. But even the chances of outflow of resources are not remote. So you have to now recollect AS4. Now, if you recollect AS4, in that we have seen that an enterprise should try to gather all the information with respect to a contingency up to the date of approval of accounts by the board of directors. So by whatever information they are able to gather, the management should decide the probability of outcomes of a contingency. And we saw three possible outcomes. First, it is probable that the contingency will happen, reasonably possible that it will happen, and remote that it will happen. Now, when we say the chances are remote, means there is no contingency at all. There is no contingency at all. The chances for you to incur a contingent liability is not possible at all. That is remote. But when I use the word, it is probable. Probable means it is more likely to happen than not. I think we have yesterday also studied the definition of a present obligation and a possible obligation. Now, when I say the word present obligation, I also told present, you can also use the word probable obligation, because probable obligations are those that on the basis of evidence available on the balance sheet date, its existence is considered as probable, that is more likely than not. But when it is about possible obligation, the existence and the balance sheet date is considered as not probable. And sir, your contingencies are possible obligation because their existence on the balance sheet date are considered as not probable. And that is the only reason why all the contingent liabilities are recorded in the notes to accounts. And the only reason is what? The contingencies are possible obligations. And the probability of outflow of economic resources is also not probable and not even remote. See, please understand. If I make a small timeline, here I can say probable, here I can say remote, right? And please understand, if the outflow of resources is probable, then I can say, sir, it is no more a contingency. Rather, you have to create a provision for the same. But when I say the chances of outflow of economic resources to settle an obligation is remote. Remote means very less chance that you have to pay something from your pocket to settle the obligation. Means it will not become your obligation only. So when it is remote, you just ignore the contingency. But sir, between probable and between remote lies possible obligation. And if your contingency or your contingent liability is in the state of possible obligation, it is always recorded in the notes to accounts. Please understand this point. Your contingencies are always possible obligations arising out of past events. And it is not probable that outflow of economic resources will be required to settle the obligation. But sir, the outflow of economic resources, the possibility of outflow of economic resources is not even remote. So it is not even remote. It is not even probable. That is why it is in between, called as possible obligation. And lastly, the amount required to settle the obligation cannot be measured reliably because you don't have reliable sources to measure the amount. But with respect to provisions, what we saw, the amount can be measured reliably. So the small hairline difference between provision and contingency are what you know. Provisions are present obligations. Contingencies are possible obligations. Point number one difference. Point number two difference. Provisions require a probable, means in case of provisions, it is probable that outflow of resources will take place to settle the obligation. But in case of contingencies, it is not probable, nor it is remote, nor probable, nor remote that the outflow of resources will take place to settle the obligation. And third point of differentiation, for provisions, we can say that the amount required to settle the obligation can be measured reliably. But sir, with respect to contingency, we cannot measure it reliably. So these are the three major differences. And sir, from where did you get these differences? Sir, these are nothing but recognition criteria of provision. And the same recognition criteria comes for contingency, but in an opposite way. Opposite way means what? Sir, first one, what we said, an enterprise has a present obligation. So for contingency, what will I write? An enterprise has a possible obligation. Second point is what? It is probable that an outflow. So I will write it is not probable that an outflow of resources embodying economic benefits will be required to settle. And it is also not remote. So nor it is probable, nor it is remote. And lastly, a reliable estimate cannot be made of the amount of obligation. So if the points which I told now is satisfied, then sir, your contingencies are recorded in the notes to accounts. Right? But if we say, sir, the contingency is in such a stage that it is probable that it will require outflow of resources embodying economic benefits to settle. Sir, now resources embodying economic benefits is nothing but cash or something in kind. That is the technical word. In simple words, I am telling it is either cash or something in kind. As simple as that. Right? So if your contingency, which was already available with you, but now is at such a stage where you say that, sir, now it is 100% probable that something will go out from our pocket to settle the obligation, then in such case, sir, it is no more a contingent liability. Now you have to record an actual provision for that liability. So such situations are called as shift of contingency towards provision. So now it is no more a contingency. It will be considered as what? An actual provision to be shown in the books of accounts. I hope you are understanding the point. So basically, whenever the term contingent liability comes to you, there can be three possible accounting treatments. Wherever you come across a contingent liability, three accounting treatments are possible. And that completely depends upon the chances of occurrence. If the chances, now chances of occurrence means what? Chances of occurrence means what is the chances of outflow of economic resources. If the chances of economic resources, that is outflow of economic resources, is remote, then sir, ignore it. It is not a contingency at all. Point number 2, if the chances of outflow of resources are not probable, but sir, they are not even remote, means may or may not, then in such case, please show it in the notes to accounts. And the third possibility, when the chances of outflow of resources is probable. Probable means it is more likely to happen than not. So the chances of happening is very high. So in such case, sir, please record a provision in the books of accounts. I hope you get my point. So these are the 3 possible accounting treatments with respect to any contingency, right? So please understand this. Sir, generally, as on every balance sheet date, that is 31st March, you have to check whether any situation or condition with respect to contingency is available or not. If it is available, first check whether it is a gain or a loss. If it is a gain, it goes under contingent assets. We will discuss it later. But if it is a loss, we call it as a contingent liability. Correct? Now, with respect to a contingent liability which is existing on the balance sheet date, you please try to gather all the possible evidence and information with respect to it. Up to what date? Up to the date of approval of the balance sheet by the board of directors, that you have already learned in events occurring after the balance sheet date. Right? That same date you have to wait and gather all the possible information. Correct? Now, once on the basis of your information, you have to decide what is the chances of outflow of resources. If the chance is remote, ignore the contingency. If the chance is possible, possible means what? Not probable, not remote, between them, possible, then you have to record it as a contingent liability in the notes to accounts. And lastly, if it is probable that something will go out from your pocket to settle the obligation, please record a provision for the contingency. I hope you get this point. Right? So let us now read the definition of contingent liability. What is the definition saying? Now they say a possible obligation. As I already told you, sir, contingencies are not probable obligations. They are possible obligations. A possible obligation that arises from past event and the existence of which will be confirmed only by the occurrence or non-occurrence of one or more future uncertain events not wholly within the control of the enterprise. So this is the simple definition, or you can also define it like this: a present obligation arising out of past event, but no provision is recognized. There is a present obligation arising out of past event, but no provision is recorded. Now, why provision is not recorded? Because the outflow of resources is not probable, and you cannot calculate the amount reliably. So see, what is that written? A present obligation that arises from past event, but it is not recognized as a provision because, point number 1, it is not probable that an outflow of resources embodying economic benefits will be required to settle the obligation, or a reliable estimate of the amount of obligation cannot be made. So this is the difference between contingency and provision. You could have recorded a provision if the word not was not there over here. It is probable that. And here also, reliable estimate of the amount can be made. So just remove not from here, it becomes a provision. Because then it becomes what? An actual present obligation. So you can also substitute the word present obligation by the word possible obligation. A possible obligation that arises from the past event. So it is clearly understood. If it is possible obligation, then a provision can never be recorded for it. Because for possible obligations, we don't record provisions. We record provisions only for present obligations, because present obligations are your actual liabilities. And if I'm not wrong, all provisions are liabilities. Correct? Now, what is the treatment? An enterprise should not record contingent liability. We already know that it is not recorded in the P&L balance sheet. A contingent liability is to be disclosed. Disclosed means in the notes to accounts. Unless the possibility of an outflow of resources embodying economic benefits is remote. Means if the possibility of outflow of economic resources is remote, don't even disclose. Don't even disclose. Correct? When an enterprise is jointly and severally liable for an obligation, that part of the obligation which is expected to be met by any other party is treated as a contingent liability. I'll come to this point. Contingent liabilities may develop in a way not initially expected. Means, sir, if a court case goes on, right, the court case cannot be always in a same position. After every hearing, some new developments will come, some new evidences, some new facts and figures will come, which can change the course
of the
court case.
Yes, sir. Third sem ka timetable.
So what AS 29 says, you have to continuously keep on reviewing your contingencies for any further updates.
क्योंकि second sem का तो fourth sem का तो आ गया.
Someone is unmuted. Who is unmuted? अरे यार, Dikshit is unmuted. Yes. Muted now. But I was not getting any background noise. Okay, no problem. Back to the point. So AS 29, what it says, that after every particular time interval, say quarterly or 6 monthly or annually, please keep on reviewing all your contingencies to know about the updates. Because, say for example, you had a court case going on, correct? And in the initial 1, 2, 3, 4 hearings, your lawyer is damn sure that you're going to win the case. Correct? Now, sir, all court cases are generally contingencies only. So if somebody has done a case against you and you're liable to pay a compensation, so definitely it's a contingent liability for you, because you don't know what is the outcome or result of the court case. So today for you, it is a contingency. Correct? So today, what information is available? Sir, information is that Achha, chats are still on. Okay. Yeah. I think I forgot to switch off all these things. That is why you are able to unmute yourself. Okay. Done. Now nobody will be able to unmute, and chat will be done only to me, not with any other person. Okay. So what was I saying? If you are having a court case and in the initial days, in the initial 2 or 3 or 4 hearings, your lawyer says that, boss, you are definitely going to win the case, not to worry. So in the earlier stages, what will I say? The chances of outflow of resources to settle the court case is remote, because I'm going to win the case. So there will be no obligation on my side to pay anything. So the chances are remote. I will ignore the contingency. Right? Say in the first quarter, I ignored the contingency because I make quarterly statements. I ignored the contingency. Now in the second quarter, now my lawyer says that, boss, opponent is very strong. So it's going to be a tough fight. Earlier, I told you that we'll definitely win, but I don't know from where this lawyer is getting these evidences. So there is equal chances for both of us. So now can I say there is an improvement in the court case? So now you can say that the chances of outflow is no more remote. But sir, it is not even probable, because he says equal chances. Right? So you may win or you may not win. So you cannot directly say that the chances of outflow is remote. No, it is no more remote now. There is a chance that something can go, but it is not probable that it will go. There is a difference between these two words. It may go and it will go. So at this point, it is under that stage. It may go. So I can say it is now a possible obligation. And if it is a possible obligation, you have to record this court case as a contingent liability in the notes to accounts. Right? And now finally in the last quarter, fourth quarter, third quarter also proceedings went on. Now finally in the fourth quarter, he says that boss, opponent is too strong. Superb evidences they have given. I cannot more track the case. Maximum in 1 or 2 hearings, the judgment will be given, and the chances are we will lose. So be prepared for the penalty that has to be paid by you, because that will be levied by the court on you. If you want, we can further appeal in the higher courts, but as of now, we are definitely going to lose. So now what is the logic? Sir, till the second quarter end, it was a possible obligation, and now by the end of fourth quarter, it is going to be a probable obligation. So as on 31st March, you have a probable obligation. That is nothing but present obligation, because your court case will be settled somewhere in May, June or July. So you have a present liability in your head. So now it is no more a contingent liability. It is now shifting from a contingency towards provision. So you have to create a provision for loss, and you have to calculate the amount reliably now. So that is why they use the word key. Contingent liabilities may develop in a way not initially expected. So initially we expected that we will win the case. But sir, after a few period of time, first we thought equal chances, and then now the lawyer says, boss, you are going to lose. Therefore, they are assessed continually to determine whether an outflow of resources has become probable or not. Because the day when outflow of resources become probable, right, then you have to record the provision. Right? And what do you mean by this concept? When an enterprise is jointly and severally liable for an obligation, the part of the obligation which is expected to be met by other party is also treated as a contingent liability. Now, please try and understand this simple point. Please try and understand this. Mr. A sold goods to Mr. B, right? Mr. B sued Mr. A for inferior quality goods, correct? Mr. A demanding compensation from Mr. Z, who supplied goods to Mr. A. Correct? Therefore, the amount receivable from Mr. Z is also a contingent liability. Now, how can you say, sir, receivable from Z is, how is it is a contingent liability? Sir, because say if you are sued for 50,000, so you are expecting that from Mr. Z, you will collect 30,000 and balance 20,000 you will pay from your pocket only. Correct? So logic is, if Mr. X does not pay, the entire liability is upon your head only. Na? Yes or no? So technically the amount that you are planning to get from Mr. Z and pay back to Mr. B is always treated as a contingent liability for you. Don't take it as a contingent asset. It will be a liability for you. That if he does not pay, then you have to pay from your pocket. That is what the point says. What is the point saying? We'll read it again. When an enterprise is jointly and severally liable for an obligation. So here in this case, Mr. A and Mr. Z both become liable to Mr. C. Because, Mr. B, because end of the day, Z is the main supplier who has supplied inferior quality of goods. So Z gave to A gave to B. So technically, A and Z both are jointly liable. So that part of the obligation, which is expected to be met by the other party, is a contingent liability for us. Why? Because if that party doesn't give, who will give? Sir, we have to pay from our pocket. So that is always shown as a contingent liability, right? In the notes to accounts. But if the other party has agreed, sir, don't worry, my mistake, I gave you wrong goods, whatever is compensation, we will pay. Whatever is my share, you tell me, I will pay. Then I will say, sir, there is no contingency at all. Because the chances of outflow is remote. Ignore it. But if he says you that, okay, acha, bad quality goods, okay, acha, how much will be my share? Acha, 30,000. Okay. We'll try to give you, but don't 100% count on me because I am not doing in a good financial position. We'll try to give you. Don't worry. If in that way is he saying, so can I say it is a possible obligation? Because the words that he is using clearly states that he may or may not pay. Correct? So record it as a contingent liability in the notes to accounts. But if he says, go to hell, I will not pay you. In simple, in Hindi, we say, jo ukhadna hai, ukhad le. Whatever you want, you do it. Right? Whatever you want, you do it. I am not afraid of you. I will not pay you. And technically, you are not in a position to do anything. So what will you say? Sir, now the loss is probable, sir. So it is a shift of contingency towards an actual provision. So I will provide for the loss. As simple as that. So this is how you understand contingencies. Correct? Now moving on to the last point of contingency. That is, when should a contingent liability be disclosed in the notes to accounts? I have already discussed the recognition criteria. Now, what are the recognition criteria? Point number 1, there is a present obligation arising out of past event but not recognized as provision. But sir, apart from this statement, you can also write this statement also. There is a possible obligation arising out of past event. So you can write either there is a present obligation arising out of past event, but don't forget to write but not recognized as provision. Because if you don't write but not recognized provision, then this statement till here becomes wrong for contingencies. Because contingencies are never present obligations arising out of past events. Right? So with this statement, you have to write the last 5 words also, but not recognized as provision. So since they are not recognized as provision, then they are called as contingencies. So if you are not able to remember the last 5 words, better you write what? There is a possible obligation arising out of past event, full stop, that's it. Then what is second point? It is not probable that an outflow of resources embodying economic benefits will be required to settle the obligation. Third point, the possibility of an outflow of resources embodying economic benefit is also not remote. So it is not remote, not probable. So it is in between, it is possible. And lastly, the amount of the obligation cannot be measured with sufficient reliability to be recognized as a provision. So if these 4 conditions satisfied, where will you take contingent liability? Notes to accounts. Correct? Right? But if outflow becomes probable, record a provision. If outflow becomes remote, ignore. I hope you get this point. Correct? Anybody with any query can please raise. Anybody with any query can please raise. Yes, Pratham.
Good evening, sir. So I just had a doubt regarding the case.
One minute.
Sure.
Pratham, you're not audible.
Oh, am I audible now?
1 minute.
Sure.
Please speak now.
Good evening, sir. So I had a doubt regarding the court case. You told that if the court case gets settled and we lose the case, but then if we further appeal to higher courts, so what will be the accounting treatment in that situation?
Sir, if you are appealing further, you are challenging the current court's order.
Right.
But if the current court order has told you to pay some compensation, you have to pay that first and then you have to appeal to the next court.
Okay.
So whatever you are paying today, that has to be recorded as a loss.
Okay.
And then you have to go and appeal. So when you appeal in the higher court now, it will again start with a contingency.
Okay.
And again the same logic will go on
That
and
we
go on.
may or may not win it.
Exactly.
Okay, sir. Got it, sir.
Right. And some people, what they do, even after getting the court's order that you have to pay something, so they try to bring a stay on it. That
Correct.
we will not pay right now. We will appeal in the higher court, and if higher court says to pay, we will pay.
Huh. So in that
Right.
case,
Now this happens if a person has given a 10 years of jail. So what they do, they appeal to the higher court and take the person out on bail.
okay.
Or then the person has to be in the court and the court case goes on.
Okay.
Like it happened with Sanjay Dutt. He was there in for the first 3 years. He was continuously in jail, and then he was served a sentence of 8 years. So 3 years already he had covered in jail. So last 5 years he had to stay in jail. That is what generally happens.
Okay, sir. Got it, sir. Thank you, sir.
Right? Anybody else with any other query? Let us try and understand the disclosure that you have to give in the notes to accounts. What disclosure you have to give? Unless the possibility of any outflow in settlement is remote, an enterprise should disclose for each class of contingent liability at the balance sheet date a brief description of the nature of the contingent liability and where it is practically possible. Now, see, generally, please understand, a brief description of the nature of contingent liability is compulsory. Means you have to briefly disclose what is the nature of contingent liability that is currently present. That is compulsory. But point number A, B, and C, if you are able to calculate, then only you tell it, or else it is not compulsory. Point number A, an estimate of its financial effect means what will be the amount of liability. If you can measure it, no problem. If cannot, ignore it. An indication of the uncertainties relating to any outflow. That is, what are the chances of outflows? What are the chances? What are the percentages of probabilities that you can give? Indication of the uncertainties relating to any outflow. So what are the uncertainties? What are the chances? What are the odds? You can give that. The possibility of any reimbursement, that third party claims, means if you want to pay anything as a contingent liability, but you are also going to get a claim from any third party, that is form of reimbursement, then you can definitely record that as well. But reimbursement with respect to any contingent liability can be shown if you are virtually certain that they are going to reimburse if you lose the case. Now, what they say, where any of the information required by above paragraph is not disclosed because it is not practically possible to do so, that the fact only should be stated. So means logic is what? A brief description is compulsory. And point number A, B, and C, if you are not able to calculate, please ignore it. You can please leave it. Correct? It's simple, it's not that difficult. Now moving on to the last part of the topic, that is contingent asset. Now, sir, contingent assets definition is exactly opposite of a contingent liability. Now, in contingent liability, what we learned, it is a possible obligation. Sir, here it is not an obligation. Here it is your asset. Here it is your asset. So we use the word possible asset arising out of past event. Correct? And there it was the outflow of resources embodying economic benefits. Here it will be inflow of resources embodying economic benefit. And sir, trust me on this, contingent liabilities can never be recorded in the financial statements only. Means not in the P&L, not in the balance sheet, and not even in the notes to accounts. They are not allowed as per purely conservatism principles. So technically, all your contingent assets are recorded only and only in the board of directors report, only if they are material and only if they are possible assets. If they are remote assets, ignore them. If they are remote assets, ignore them. So what the definition says, a contingent asset is a possible asset that arises from past event, the existence of which will be known only on the occurrence or non-occurrence of one or more uncertain future events, not wholly within the control of the enterprise. Exactly same definition of the contingent liability, but only change, it is a possible asset. It is a possible asset. Correct? What treatment? Sir, no treatment only. You have to show it in the director's report. Right? It will not come in the financial statements at all. And how to disclose will not be given only, because in director's report, the directors has their own choice to write. So there is no standard practice of you have to disclose in this manner. If it is to be disclosed in notes to accounts, then the standard format will be given by the AS. But sir, one soft corner for AS 29 on contingent asset. And what is that soft corner? You know, they say that if your contingent asset becomes a probable asset means it is virtually certain that there will be an inflow. There will be an inflow of resources embodying economic benefits. Then a contingent asset can be recorded in the books of accounts. So you can record an asset and you can record a corresponding revenue out of it. You can do so. But what are the conditions? It should now become a probable asset and it should be virtually certain. Now, when I use the word virtually certain means I can see that virtually it is certain that it is my asset now. Right? So if you are virtually certain and the asset becomes probable asset for you, then definitely, sir, you can record the contingent asset as well as the corresponding revenue out of it in the statement of profit or loss. So what it says, an enterprise should not recognize a contingent asset, okay, sir, where an inflow of economic benefit is possible. The contingent asset is usually disclosed in director's report and not in the financial statement. Contingent assets are assessed continually, same like contingent liability, you have to keep on assessing. And when it has become virtually certain, I've seen written probable asset, that an inflow of economic benefit will arise, the asset and the related income should be recognized in the financial statements for the period in which the change has occurred. So this is it with respect to contingent assets. Anybody would like to ask anything, then please go on. Yes, sir.
Sir, I just had a clarification. So if it is a probable assets, then if we record it in the financial statements, that'll be against what do you say? Conservatism
No, it is not against conservatism, because it is virtually certain that you are going to win the particular court case or whatever it is, whatever type of contingent asset it is. And it is probable. Probable means it is more likely to happen than not.
Correct.
So the chances of occurrence are too high.
Okay.
Right? The chances of occurrence are too high, and even it is virtually certain. Then technically you can record the asset in the books of accounts.
Okay, but so
I'll
like
tell you one more thing. AS 29 has told it. But sir, it is the common market practice that nobody records it.
Okay.
They will record it only after the court order is received.
Okay.
Common standard market practice.
Okay.
Many of them even not even know this. AS 29 says this. Because majority logic is what? Contingent asset don't record.
Okay.
Right?
Got it, sir.
Yes. Anybody else? Anybody with any point with respect to contingent asset or liability? Any point? I'll wait for 10-20 seconds. If nobody asks, I'll go ahead. Yes, Ritika.
So just in case if we record the contingent asset and later it turns out to be a loss for us, is there a treatment to reverse it?
Yes, you have to reverse whatever you have done.
Okay, thank you, sir.
You just have to reverse. Asset, you have recorded the asset as contingent asset to P&L, right? Reverse the entry.
Okay, thank you, sir.
Yeah. See, nobody asked me this query, so even I am only telling from my end. See, nobody asked me, sir, why actually you don't record a contingent asset until and unless it is not virtually certain. Now, please understand, actually, when you record a contingent asset, this is the journal entry that you put. That is contingent asset account debit to P&L account. Means technically you are crediting your PL account. And sir, when you credit your PL account now, it means you are recording a revenue in the PL account. And you are recording such a type of revenue which you have not yet earned, and there may be a chance where you will not even earn it. So how can you record such a revenue now? So it is completely against conservatism. That is why we never record a contingent asset in the books of accounts. But when it becomes virtually certain, it is a probable asset, then you can record it. Then you will record it not in the form of a contingent asset, but you can record it in the form of an actual asset. So if any compensation is receivable, so you can directly pass the entry compensation receivable account debit to P&L. And if by chance anything goes wrong, reverse it. You always have the option of reversing. So why to worry? Right? But after being virtually certain, how can the things go wrong now? Until unless the opposite party don't buy out the judge. That is a different story. Right? As you see in your Hindi and other Hindi movies, I think you people watch or don't, I don't know. But it generally happens in movies. Right? Let us go ahead then. We'll go for the questions now. I think some 3 or 4 questions are left from the topic. So let us complete those questions. We will start with question number 1. Question number 1. At the end of the financial year ending 31st December 2017, a company finds that there are 20 lawsuits outstanding which have not been settled till the date of approval of accounts by the board of directors. So since they have not yet settled, so technically the condition or situation is still existing on the balance sheet date with respect to the contingency. And I think they have calculated or given us the possible outcomes estimated by the board. So the board has estimated some possibility of outcomes. So let us understand what are the possibility of outcomes and decide whether the contingent liability is in a remote situation or reasonably possible situation or probable situation. Let us understand. In respect of first 5 cases, the winning chance is 100%. Now, sir, if you are 100% going to win, means 0% you are going to lose. Yes or no? So what should I do with the contingency? Show it as a contingent liability or ignore it? I will ignore it because the chances of loss is 0. See, generally, please understand this one standard practice which is followed by the institute also. Always check loss percentage. Always check loss percentage. If the loss percentage is from 1 to 30, we say it is remote. If it is 31 to 70, we say possible. I think I had already written this earlier also in AS4. And if the chances of loss is 71 to 100%, we say it is probable. So when it is remote, ignore. When it is possible, record in notes to accounts. And when it is probable, create a provision. Please note down these points as important point in anywhere in your notebook. This is the standard percentages that is used by ICAI also and some outside accounting standard agencies also. Noted. Okay. So, in the first case, the winning chance is 100%, so losing chance is 0%. Can I say it is remote? I will ignore contingency with respect to 5 cases. Then, next 10 cases, winning chance is 60%. So, if winning chance is 60%, can I say the chance of losing will be 40%? Correct? Now, how they say 40%? They say, if we lose, there is a chance of low damage, but the outcome is 30% of low damage, which is 1,20,000 per case. And losing with very high damages, 10% chance, where we can have outflow of 2 lakh rupees. So the total chance of losing is 40%. Total chance of losing is 40%. Correct? Then for the last 5 cases, winning percentage is 50. So if winning percentage is 50, so technically the losing percentage will also be 50. So how that 50 is shown? 30% chance of losing with low damages, where the loss per case can be 1 lakh. So how will I read this? The chances of 1 lakh loss is 30%, or chances of 2,10,000 loss is 50%. But sir, 20%. But overall, there is a 50% chance that you will lose. So in sir, both these situations, I can say it is a possible obligation. In both the cases, I can say it is a possible obligation. And outcome of each case is to be taken as a separate entity. So that is why I am considering this as per case, not total loss of 10 case or total loss of 5 case. It is per case loss. Ascertain the amount of contingent loss and the accounting treatment in respect thereof. Now, sir, accounting treatment is not an issue, but let us try and understand how to calculate or ascertain the amount of contingent loss. Now, sir, what will be accounting treatment? Sir, we have to write the recognition criteria of contingent liability in the notes to accounts as the provision paragraph. Those 4 points we have to copy paste as it is. And then we'll say that for the first 5 cases, the chances of outflow of resources is remote. Hence, the contingency has to be ignored. Right? For the next 10 cases, the chances of winning is 60%. So losing is 40. And for last 5 cases, 50-50 chance. So for these 15 cases, it is neither that it is not probable and neither it is not remote. So such case we consider that it is a possible obligation. And for them, we have to record or we have to show them in the notes to accounts. Means it has to be disclosed in the notes to accounts. But the important point is, how will you calculate the amount of loss? Because some data is given to you. So how will you calculate the loss? Now please understand this. Please understand this for 10 cases. Right? Now, low damages. Low damages 1,20,000, and the chance of this 1,20,000 is 30%. Plus high damages 2 lakh, and the chance is 10%. Right? And this is for 10 cases. So I would say 10 into 36,000 plus 20,000. Sir, but how are you doing this 36 and 20? Now, please understand, I cannot give a bigger or a huge amount with respect to a contingent liability. That will not be a correct estimation. So what I'll say, sir, the probability of 1,20,000 loss is only to the extent of 30%. And the probability of 2 lakh loss is only to the extent of 10%. So since probabilities of both of them are given and the total probability is 40%, take the total of this. So 30% into 1,20,000 and 2 lakh into 10%. So total will be how much? 56,000 loss per case. So for 10 cases, 5,60,000 can be the contingent loss. And this is not a reliable estimate. This is upon the best possible things we can do. This is not a reliable estimate. Then for the 5 cases. Now, first, low damages 1 lakh. 1 lakh low damage, and the probability is 30%. And for high damage, the probability is the amount of high damage is 2 lakh 10, and the probability of happening is 20%. So I'll say the overall chances of low damage loss is 30%, is 30,000, and for high damage is 42,000. So total will be 72,000 multiplied by 5, 3,60,000. So therefore, total contingent loss will be recorded in the notes to accounts as 5,60,000 plus 3,60,000. So total is 9,20,000. Yes, Ritik.
Sir, apologies for asking, but could you please repeat the percentages? Why did you are getting into notes to accounts? I was like, you were not audible for me. There was some connectivity issues.
See, winning percentage is 60, so losing is 40% total.
Okay.
So 40% outcome. When the outcome of loss is between 30 to 70%, generally we consider it as a possible loss.
So we have to club it, sir, like 30 plus 10 and 30 plus 20.
Yes. See, what is you're not getting this point. If the question says that the chances to win is 60%, right? So it is implied that chances to lose is 40, right? So you are definitely going to lose 40% chance of losing, right? Now, if there is a chance of 40% that you are going to lose, they say that you can either lose with low damages or you can either lose with high damages.
Okay.
So what is the percentage of low damage loss? Sir, 30% chance. And what is the chance of high damage loss? 10%. So overall total 40% chance of loss.
Yes, sir.
Right. And since the percentages are given, I multiply them with the respective loss figures. Because if I don't multiply them, what will happen? 1,20,000 plus 2 lakh, it will become 3,20,000 into 10 cases means I have to show contingent loss with respect to 32 lakh rupees. And that may not be, that will be a very big amount of contingent loss to show.
Yeah, overestimation basically.
Overestimation basically. So that is why we are considering the chances of loss of 2 lakh is only 10%. So we have learned this in our probability chapters also. We try to multiply our, you have calculated that mean, median, mode, and in that also the chances come. Like if you are going to earn 50 rupees, the probability is 0.2. To earn 40 rupees, the probability is 0.3. To earn 20 rupees, the probability is 0.1.
So always you will calculate each thing separately.
Yes.
And
so what you
not
do
club.
is 50, 60 and probability to earn 10 rupees is 0.4. So what we do is multiply all these 4 and find out one middle figure, median figure. So that is what we have done over here.
Got it. Yeah.
Because there are 2 chances. You can either land up paying 1,20,000 or you can land up paying 2 lakh. So let us take the chances of it. And 60% balance is what? If you win the case, 0. So 60, 30, 10. That is how it is divided. So 60% chances you win, loss will be 0. So it is same like this calculation you used to show in your college for the probability calculations. Same logic we have applied here.
Okay.
Yes, Pooja.
Sir, how do we get to know the amounts, whether it is per case or full for 10 cases?
Outcome of each case is to be taken as a separate entity.
Okay, sir.
So this is outcome of each case. That is what we are considering.
When such thing is given, we should take it as per case and do it.
Definitely.
Okay, sir. Thank you.
So let's go for the solution. It is printed. See, the first part, as I told you, you have to write down the entire recognition criteria of contingent liabilities. Now what it say? According to AS 29 provisions, contingent liabilities and contingent assets, contingent liability should be disclosed in the financial statement if the following conditions are satisfied. So these are the same 4 recognition criteria which I've already taught you. There is a present obligation out of past event but not recorded as a provision. It is not probable that the future outflow will be there. The possibility of outflow is also, benefit is also less likely to occur. Now, less likely to occur, you please use the word, the possibility of an outflow of resources embodying economic benefit is also not remote, because we have already learned this many a times, not remote, not remote. So any other word unnecessary will try to create problem, or you will not understand it properly. So please write not remote. And lastly, the amount of obligation cannot be measured with sufficient reliability to be recognized as a provision, or you can directly write the amount of the obligation cannot be measured reliably. The same 4 recognition criteria of contingent liabilities. Now, in this case, the probability of winning the first 5 cases 100%, and hence question of providing for contingent loss does not arise. So it is remote, you have to ignore it. Then the probability of winning of next 10 cases 60%, and for the remaining 5 cases is 50%. So as per AS 29, we make a provision if the loss is probable. But here the loss is not probable, it is possible. As the loss does not appear to be probable, and the possibility of an outcome of resources embodying economic benefit is not remote, rather there is a reasonable possibility of loss, means it is not even probable, not even remote, so it is in between both of them, it is possible. Therefore, disclosure by way of notes to account should be made. And for the purpose of the disclosure of contingent liability by way of a note, the amount may be calculated as follows. And I've already shown you the calculation. For the first 10 cases, 56,000 per case should be your loss. For the balance 5 cases, 72,000 per case. So to disclose the contingent liability on the basis of maximum loss will be highly unrealistic. That is why I'm not showing the maximum loss, 32 lakhs in the first case and in the second case. So don't show maximum loss, it will be unrealistic. Therefore, the better approach will be to disclose the overall expected loss at 9,20,000. That is 56,000 for 10 cases plus 72,000 for 5 cases as contingent liabilities. So this will be your solution for question number 1. Yes, Pratham.
So what do you mean by maximum loss over here? What do they mean by maximum loss?
Maximum loss means you add up both losses figure and then directly multiply by 10 case and 5 case. So in the first 10 cases, it will be 32 lakh rupees.
Okay. So instead of choosing one of them, if we choose maximum loss, it'll be combining both the figures and doing it.
Combining both of them, or you have to consider the maximum figure. Now, what is the maximum figure in the first case?
2 lakh.
The maximum loss is 2 lakh. So if you consider 2 lakh into 10 cases, then it is 20 lakhs. And in the second case, 2 lakh 10 into 5 cases, that is 10 lakh 50,000. So total provision, total contingency will be shown at 30 lakh 50,000. So that becomes too high.
Yes.
So that is why we are, since the percentages are given, we consider them as per their probability of outcomes only.
Got it.
Correct.
Thank you.
Shall we go for the second question, or anybody would like to ask something for the first question? Let's go for the second one. After wedding in 2004-5, 10 people died, possibly as a result of food poisoning. So eat food at your own risk at weddings from products sold by a particular enterprise. Legal proceedings are started seeking damages from the enterprise, but it disputes liability. Upon the date of approval of the financial statements for the 31st March 2005, the enterprise's lawyers advise that it is probable. Actually, we will not use the word probable because probable meaning is different. Actually, they should not have used the word probable, because they have given the solution as per the word possible. So that is why we will not consider this as the word probable. We will rather use the word possible. The enterprise lawyers advise that it is possible that the enterprise will not be found liable. Because if I say it is probable that we will not be found liable, means I will say the chances of loss is remote. But if I say it is possible that we will not be found guilty, so if it is possible that we will not be found guilty, then there is also a possibility that we will be found guilty. Equal possibilities. So if that is the case, as on 31st March 2005, provision will not be required, but it should be recorded or it should be disclosed in the notes to accounts as on 31st March 2005. But however, when the enterprise prepares the financial statements for 31st March 2006, its lawyer advised that owing to the development in the case, it is probable that enterprise will be now found liable. So if it is probable that you are going to be found liable, then sir, as on 31st March 2006, the enterprise should not show it as a contingency anymore. Rather, the enterprise should create a provision for the loss by reliably estimating the loss figure. How this should be dealt in the financial statements. So sir, as on 31st March 2005, just show it in the notes to accounts, disclose in the notes to accounts the contingency. And as on 31st March 2006, since it is probable that you are going to lose, you are liable to pay, then technically please create a provision as on 31st March. So let's see what solution has been provided to us. Answer number 2, as on 31st March 2005. On the basis of the evidence available, when the financial statements were approved, there is no present obligation as a result of past event. Hence, no provision is recognized. The matter is disclosed as a contingent liability unless the possibility of any outflow is regarded as remote. So if it is regarded as remote, but sir, in the question they have clearly given that it is a possible event. Right, so if it is possible, then no need to be considering as a remote also. Then at 31st March 2006, present obligation as a result of past obligating event, on the basis of the evidence available, there is a present obligation. An outflow of resources embodying economic benefit in settlement is probable. A provision is recognized for the best estimate of the amount to settle the obligation. So technically, as on 31st March 2006, since you are probable that you will be liable to those 10 people, then technically you have to create a provision for the loss. An entire recognition criteria of provision gets settled. That is, there is a present obligation arising out of a past event, right? It is probable that there will be an outflow of resources. And third, amount can be measured reliably. So technically, please record a provision now. And such cases are called as shift of contingencies towards provision.
Sir,
Yes, sir.
sir, in the question, it says if it is in the year 2005, it says that it is advised that it is not probable that the enterprise will not be found liable. So we considered it as possible and not probable. My question is why, sir? It can be not probable. It can be remote also, right, sir? And the next year it can turn into probable. So when you see that, your answer will also match, sir, because in A they have considered the matter is disclosed as a contingent liability unless the possibility of outflow is regarded as remote.
Now the answer matches only because of this last statement.
Yeah.
Correct. But if in exam you don't write this last statement,
Yes,
then your
sir.
answer becomes completely wrong.
Yes, sir. So that's what I'm saying. We can write the write it as in 2005. It was because the situation was considered.
How you will present is you can directly say it should be shown or it should be disclosed in the notes to accounts, considering that the chances of outflow of resources is not remote.
Okay, sir.
Right? So that is one point also you have to write. Means if I go with the question and I stick to the word probable, but generally what happens, I'll tell you one thing. Generally, when you see the word probable, the first thing that comes in your mind is what you know. Sir, it is probable that there will be no liability. Means I am definitely going to win. So first thing that comes in your mind is what you know. You will ignore it. Yes or no?
Yes, sir. Yeah.
What do you think? Means am I correct with this? Or you don't
Correct.
will you accept my point? Means whenever you see the probable word coming first, the first thing coming in your mind is, Arey boss, if it is probable that I'll not be liable, means it is remote chance that there will be a loss. And if there is a remote chance, then I will ignore it.
Yes, sir. I understood. But my point is, what is wrong in that? I might ignore in 2005. And in
But
2000, yeah.
Then you have to frame your answer accordingly.
Huh.
So what in such case, what you can do is, if you're considering it as probable, so what you can write is, since the liability will not occur is probable,
Yes, sir.
the enterprise can ignore the contingency considering that the chances of outflow is remote.
Huh. Okay.
But you, for the safe side, you can also write one more point like over there. But if it is not, if the outflow of resources is not considered as remote, but is considered as possible,
Then you
the
will
enterprise
disclose.
should disclose in the notes to accounts. So I would recommend, if you're writing, please give dual answer.
Take it.
Because you
Yes.
don't know what is the standard solution available with that person.
Huh.
That is why in this question I'm telling you, use the word possible over there, because the word possible only matches with the solution. Because whenever the word probable comes in, we can have two minds.
Take it. Huh.
Right?
Yes, sir.
Anybody else? Any point with question number 2? We'll go for 3 then. Right. CAPS has 50 students of CA-PCC. CA-PCC was when I was a student, professional competency course. Then it becomes CA-IPCC, integrated professional competency course. And now it has again come back to CA-Inter, which was called way back in the year 90s, and before 2007, we used to call it as CA Foundation, CA P1 and P2, that were the names. So CA PCC, the guarantee with guarantees, CAPS has 50 students of CA PCC with guarantee for returning 5,000 rupees if the student does not succeed. Means technically, if the student fails, they will give 5,000 rupees back. Our assessment puts 60% probability of success. 60% probability of success, whether the provision need or to be disclosed as contingent liability. Means whether you have to record a provision or you have to disclose in the notes to accounts is what they are asking. Now, sir, this is actually a bit tricky question, and a lot of discussions also had taken place in the morning batch. So, sir, here actually there are 2 ways of giving an answer, and both the ways give 2 different answers. Now, what they have given, 60% probability of success. Now, sir, here it is to be considered as, if I go with one single student, 50 student, every student, means first I'll take, for example, I'll talk about Vishal. So 60% chance Vishal will pass, 40% chance he will not pass. Ritik, 60% chance he will pass, 40% he will not pass. Pratham, 60-40. Right, so all students 60-40 ratio, because one student's result is not related with the result of other student until and unless they are not sitting in front and back in exam and copying everything. Right, so technically the result of one student is not related to the result of another student. So if I go individually one by one, the chances of success is 60%. So the chances of loss is only 40%. So 40% means it is a possible obligation, not a probable obligation. So if I go individually, I would say no need to create a provision, just show it as a contingent liability. That is the first situation. But sir, if you take on overall batch wise, it is as good as service provided with guarantee. It is as good as a service provided by guarantee. So you have to create a provision, because if you say I am providing service to 50 students as a whole and 40% will fail, means 20 students are definitely going to fail. And to these 20 students, I am obliged, I am liable to pay 5,000 rupees per student. So technically, I have a liability of 1 lakh. Create a provision. So sir, it is very much similar. If I take all students as a group, it is very much similar to service provided with guarantees. And sir, for guarantees, I have to record the provision. I hope you get my point. So in both the situations, they have answered, right? In both the situations, answer is provided to us. In the first case, one minute. Just a minute. What happened to settings? Now what answer is provided? Individually, each student result is independent from each other, but these are related and similar cases. If we see individually, then only 40% chance of failure. That means liability of 5,000 will arise is not probable. It is possible. Hence, no provision is needed. Only disclosure as a contingent liability is correct. But the above view is not appropriate. We should take a whole group of 50 students together, and we can say that likelihood of 40% failure, which means 20 students may fail, requiring a payment of 5,000 into 20, 1 lakh rupees. And hence 1 lakh liability should be provided for. It is very much similar to provisions for guarantees or warranty sales. Very much similar to that. Because if you say that there is a success rate of 60%, means 40% of the batch will fail. And sir, generally, if I say that I have a result of 30% at CA interlevel, so what does it mean? Out of my 100 students, sir, 30% student pass means 30 students pass and 70 students flunk. It is never considered with one-to-one basis. Now, on one-to-one means what, sir? 70% he will fail, 30% he will pass. Means out of 8 groups, he can clear, out of 8 subjects, he can clear 3 subjects and balance 5 subjects he will not clear. Like that you speak? No, sir. When I say about a result of a particular batch, it is always with respect to the total batch. And when you say 40% failing ratio, means 40% of your students will fail. So you have to create a liability. Yes, and Anshul.
And we can directly give the answer for the provision rates. Then why to give the first paragraph as
No, sir. No, sir. Both views are correct, sir.
So, but you only know, sir, that if we take individually, it is not possible to make estimation properly.
No, sir. I am correct with that. But please try to give both the possibilities in the exam.
Okay.
Because, sir, both the angles are possible.
Okay.
Individual angle is also possible, total angle is also possible.
Sir, if
More correct is the total angle.
okay,
But
okay.
the prior angle is also single individual student angle is also possible.
Sir, if in question there was not mentioned regarding the guarantee, sir, then what would be the answer? Something? If there
Then
are
sir, question would have only not been there.
okay, different type of question then.
Exactly, because the main logic of question is what, that we have given a guarantee of 5,000 rupees if we fail. If I have not given any such guarantee, then how there is a contingency, or how can I create a provision?
Ah, yes, sir.
Right.
So, sir, I'm just interpreting the things what you are telling, sir. Like this 60% probability of success means that 60. I'm audible, sir.
Yes, please go on.
So this 60% probability of success means that 60% of total students will pass, and it doesn't mean that the success ratio of all the student passing is 60%, right, sir?
Can you please repeat?
This so this 60% probability of success means that 60% of total students will probably pass, and it doesn't mean that all the student passing is 60%. The success ratio of all the student passing is 60%, right, sir?
No. You're right. Means out of my total batch, 60% students will pass. It is
Yes.
not like that our student will give 60% result.
That's
Means every student will get 60% or above. No, it's not like that. If every student is getting 60% or above, then all 50 merit ranks will be with us.
yes, right.
Because technically above 55%, you get a merit rank at CA level. And I think this time in the old course, the people, those who got 55, 56% also at final level, they got top 10 ranks.
Okay.
Means out
Okay,
of
sir.
800, the people, those who scored 450, 460 or 480, they got the top 10 ranks. So this
Okay,
year
sir.
the ranks were at very low marks.
But sir, if the question mentioned that the 60% of success is those, like if the question mentioned that all the student passing is 60%, then we would have shown it as a contingent liability, sir.
Means you are saying that if the student does not get 60% marks, then we will give 5,000 rupees penalty, that is refund of fees.
No, sir.
Then
Like if the batch of 50 students, all the 50 student passing is 60%. So in that case, we will treat it as a contingent liability, sir.
it means every student will get 60% marks, or total
No,
60%?
Every student is passing.
Huh.
So whole 50 student batch of passing is 60%.
Means every student individually will get 60% marks.
Yes, sir. Like every student is passing.
With 60%
So in that
marks.
case, no, sir. I'm just telling that every student passing is 60%. That's what I'm telling, sir. Then we would have treated as a contingent
First
liability.
angle, individual angle. Tell like that, individual angle.
Yes, sir. Yes, sir.
Then it is a contingency.
Yes, sir. Okay, sir. Got it, sir. Thank you.
Right. Hey, this is there in the JKSC material here, where you are telling me to show one solution or second. This is there in the JKSC material. Mahesh, please check JKSC material. Question number 7, last question now. Sham Limited. This is a very, very nice question. Very nice question. Sham Limited provides consultancy. Now, Sham Limited is a public sector company. Technically, it's a government company. Provides consultancy and engineering services to its clients. Okay. In the year 2010-11, the government has set up a commission to decide about the pay scale revisions. The pay will be revised with respect from 1st January 2006 based on the recommendations of the commission. So technically, they are going to retrospectively increase the salary of the employees. So currently, we are in 10-11, and they are going to increase from 1st January 2006. So technically, almost 4.5 years retrospectively, they are increasing the salary. No problem, sir. The company makes the provision of 680 lakhs for pay revision in the financial year 10-11 on the estimated basis, as the report of the commission is yet to come. So company knows that the salary will be high. So it is their present obligation to pay out all the salaries. So what company did on their estimations, created a provision of 680 lakhs. So they might have passed the entry P&L account debit to provision for salary hike, or P&L account debit to provision for salary increment, whatever it is. So 680 lakh is debited to the P&L. Now, here is the most important part of the question. As per the contracts with the client on cost plus job, the billing is done on the actual payment made to the employees and allocated to jobs based on hours booked by these employees on each job. So technically, this is a cost plus job. Cost plus job means, sir, it is similar to the cost plus contract that you learned in AS7. So whatever actual cost of employment is to the company, that plus a certain profit margin will be billed to the clients based on man hours. So they will calculate how many people are working, what are their man hours, what is per hour rate plus our profit margin, that they will charge to the customers. And this is a common practice done in the market. This is a common practice, and all IT companies providing services to international clients, they do the billing in this way only. Means if 5 people are working on a project and the total salary of that 5 people is say 50 lakhs, correct, and say they are working 1000 hours a month total, 5 people collectively are working 1000 hours a month, right? So what is per hour rate? 50 lakh divided by 1000. So 5000 rupees is per hour, manly hour. So 5000 plus 100% or 200% profit margin, these IT companies will. Now my cousin works in L&T. She has some salary of 65 to 70,000 a month, and she is working with a European client, I think some Sweden-based client. So they are billing the Sweden-based client, she says, thrice of my salary. So they are billing the company at 2,25,000 per employee. And technically they pay her only 70,000, and balance goes to L&T Infotech's account. Obviously, L&T Infotech has to bear so many other overheads, so they will charge double. So my point of agenda is what? Whatever is the actual cost to the company of employees, that will be billed. So what conclusion I can derive from here, you know? This entire 680 lakh of pay revision is reimbursable asset for us also. Because this 680 lakh I will bill to the company, I will bill to my client, and my client will reimburse it. So the technique is what? If I'm recording a provision, I will also create a reimbursable asset because it is virtually certain. I have entered into a contract with the company's boss, so they have to pay me. It's a cost plus job, right? Yes, Ritik.
Sir, no, sir. Just another example. I was interning at GT Grant Thorntons, an audit-based company.
I know
So,
GT.
so there, the manager's salary is the normal as per market standard, but the hourly rate that they used to charge was $500 per hour.
$500.
That is
Per
at managerial. Yes, sir. At managerial level.
37,000, 35,000 per hour.
Yes, sir.
And salary given to the manager will be 12 or 15 lakh rupees per annum.
Yes, sir. Around that.
Because at GT, if I'm not wrong, the director level or the partner level, they get an associate director, or that level they give around associate director and all, they give around 40-45 lakhs package. So you are a chartered accountant at GT.
Yes, sir.
Associate director I'm talking about.
Yeah.
So managing people and chartered accountants would be paid around 15 or 20 lakh rupees, if I'm not wrong.
Yes, sir. Yes, sir. Max 20.
Right? And they are collecting 37,000 rupees per hour. Just imagine, boss, what a level of profit margin these people are having. And for the foreign client, $500 is peanuts.
Nothing, sir. Nothing.
It is nothing for it. So they pay it. My cousin also says, when before L&T, she was working in a local IT company. It was a private limited company. And they used to bill the US clients in dollars. So she used to tell her salary in that company was only 25,000 rupees. But they used to bill 4 to 5 times of her salary. The 25,000 she is working per month and they bill for 1 lakh, 1.5 lakh. And they pay only 25,000 to her. So that generally happens. Right? So here the point of agenda is what? That this 680 lakhs that we are liable to pay to our employees, sir, end of the day it will be recovered from our client when we bill them. So technically, this 680 lakh is also a reimbursable asset for us, which is virtually certain because we have entered into a contract. Correct? Let us go ahead. The company discloses through notes to accounts. Salaries and benefits include, now this is the disclosure that the company has given. Salaries and benefits include the provision of 680 lakhs in respect of pay revision. The amount chargeable from reimbursable jobs will be billed as per the contract when the actual payment is made. So when we actually pay 680 lakhs to our employees, we will bill it to our client. So the client will reimburse. That is the meaning of reimbursement. No? You pay first, then you get later. And since this is a cost plus job, we get the total reimbursement of cost plus our desired rate of return. Now, what is their accountant feeling? The accountant feels that the company should also book or recognize the income by 680 lakhs in the P&L account as per the terms of contract. Now, sir, if you see the terms of contract, you generally bill when you first pay to your employees. Before paying to your employees, you will not bill to the client. So can you record the revenue of 680 lakh directly now? No, sir, it is against conservatism because you have not raised a bill yet. And you have not yet paid your employees also. He says that if you don't write this income or you don't book this income, it will be violation of matching concept and understatement of profit. Means he says that on the debit side, you are putting provision for salary 680 lakh. So on the credit side, you put the revenue also. If you don't put the revenue on the credit side, matching concept will not be done. And secondly, your profits will be understated. I said, fine, you're correct with respect to violation of matching concept and understatement. But you cannot show 680 lakh as a revenue. But you can always show it as a reimbursement claim. So if you show it as a reimbursement claim, then what will happen? Sir, from the debit side, to provision minus reimbursement claim that I taught you yesterday. So the net effect to the P&L will be 0. Comment on the opinion of the accountant with reference to the relevant accounting standard. So, sir, what answer we have to provide? Sir, this is a question purely based on provision subject to reimbursements. So we have to write the first paragraph as it is copy paste of the reimbursement part that I taught you yesterday. That a company, if a provision is to be created and it is backed up by a particular reimbursement, and if it is virtually certain, then the reimbursement should be recorded in the books as a reimbursable asset, and the reimbursement amount cannot be greater than the amount of provision. The first paragraph is what we have to put with respect to the provision paragraph, and then explain the entire case. Some part of the solution I have also cut because it is not, I feel, relevant. Unnecessary, it drags the answer to a very lengthy one. So what it says, as per AS 29, where some or all of the expenditure required to settle a provision is expected to be reimbursed by another party, the reimbursement should be recognized when and only when it is virtually certain that reimbursement will be received if the enterprise settles the obligation. The reimbursement should be treated as a separate asset, and the amount recognized for the reimbursement should not exceed the amount of the provision. So this first paragraph is nothing but copy paste of what I have given in the notes. The same first paragraph has to be pasted. Then I have cancelled this part because it is unnecessary dragging the answer to a very lengthy one. So I have cut this part, not required. You can directly start from here. In this case, the provision of salary to employees of 680 lakhs will be ultimately collected from the client as per the terms of contract. Therefore, the liability of 680 lakh is matched by the counter claim from the client. Counter claim will be nothing but reimbursements. Hence, the provision for salary of employees should be matched with the reimbursable asset to be claimed from the client. It appears that the whole amount of 680 lakh is recoverable from client, and there is no significant uncertainty about the collection. Hence, the net charge to the profit and loss account should be nil, because you will debit the provision and from there you will subtract minus reimbursement claim. The opinion of the accountant regarding recognition of income of 680 lakh is not correct as per AS 29 and also not as per the concept of prudence. If 680 lakh is recorded as an income. So what you have to do, 680 lakh is not a revenue at present, but only reimbursement of claim for which an asset is created. However, the accountant is correct to the extent as that non-recognition of 680 lakhs as income will result in understatement of profit. So to avoid this situation, in the statement of P&L, expense relating to the provision may be presented net of the amount recognized for reimbursement. So technically the net charge to the P&L will be zero only. Right? Because you cannot record the revenue today because you have not yet billed your client. And before billing to the client, you cannot technically record a revenue. But you can definitely record a reimbursement claim. Because as per the contract, you are going to take a reimbursement from the client of entire 680 lakhs. Yes, Anshul.
Sir, if the reimbursement asset, then we are also take it to balance sheet, right, sir? At 6.
Exactly.
And they have
same as I showed you yesterday.
Yeah. And if they tell us that in the question that the amount paid by the other party is double than the 680, that is around 1360, then also we have to record the profit, sir.
Only your amount of reimbursement cannot be greater than the amount of provision.
Okay.
So in that case, your reimbursable claim has to be restricted to 680 lakhs only.
No, sir.
Double.
We'll make the claim of 680, sir. But the remaining amount which we received from the company, that will.
Sir, you are going wrong. You are going wrong. Because if you are recording 1360 means you are planning to record the entire revenue. That is not allowed.
So then you said the example, right, sir, that they will take the double charge from the employee. Then how do they do, sir?
What example I give and what you are linking to it?
So same, no, sir. If they are.
Please, 1 minute. As on this date, I cannot record the revenue because I have not yet billed. Billing hua hai kya? Have I billed?
No, sir.
So how can I record revenue? Without billing, how can I record revenue? I am not recording revenue. I am recording the reimbursement claim. So what is the logic of reimbursement? Whatever actual expense I am incurring, that will be reimbursed by my client. So 680 lakh I am going to incur, and 680 lakh my client is going to give me the reimbursement of.
Okay, so after billing, we can record the whole revenue.
That is, yes, definitely yes.
Yeah. Thank you, sir.
Right. Anybody else with any point with this question? Anybody else? Fine, then we conclude the topic. AS 29 is completed.